Good morning, everyone. Myself, Assistant Professor Chetan Devashish Ghosh. Now, let us quickly go ahead and understand how we can effectively prepare trading account, profit and loss account, as well as balance sheet statement without by-hearting them. Now, before you go ahead and see this video, make sure that you have checked and viewed the previous video, which talks about the basics of accounting and golden rule. Now, when we prepare trading account, we have two sides, debit side and a credit side. That is indicated with DR and CR. Now, trading account is assumed to be nominal account. It is just like a nominal account. So most of the entries that we could see at the debit side of the trading account will follow the golden rule of nominal account, and the entry at the credit side would follow the will follow the golden rule of nominal account. Now, let us quickly revise what was nominal account. Nominal account is an account which represent expense, loss, gain, profit. This is what been considered as nominal account. All the entries, all the expenses and losses are considered to be posted at the debit side of the nominal account, and all the income and gains or as a profit is posted at the credit side of the nominal account. Since we consider trading account is just like a nominal account, we will see all the expenses or losses at the debit side, and we would see all the incomes or gains at the credit side. But there is a catch when we prepare trading account. Remember, trading account or else a manufacturing account is an account which is prepared for factory. It means all the expenses that you see at the debit side could be directly or indirectly connected with factory. Similarly, the credit entries would be an indicative towards the factory income. So let us try to understand now this. In a factory, we produce goods and services. When we produce goods, we need raw material. If there is any leftover raw material of the last year, which is now known as opening stock, which would be utilized this year. So this is an expense of the current year. So the opening stock, which is an expense, which is actually a raw material which was left at the last year, would be utilized this year. So this is an expense of the current year. So we write opening stock at the debit side of the current account. I hope so you're clear with this entry. Now the next is purchase. When we make purchase, why we make purchase? Of course, for production purpose. What kind of purchases that we make generally? We make purchases of raw material. So again, it is an expense. So it will come at the trading account debit side. Okay, debit the all expenses or losses. So purchase is an expenses. But what if I return some raw material? The reason is might be they are not of good quality, or else they have been over ordered. So that could be also one of the reason why I written them. So those purchases would be reduced from the actual purchase amount, known as less purchase written, also known as technically written outward. Okay. So the net purchase amount would be written at the column of amount. I hope so you're clear why we are writing purchase, because it is an expenses. Why we are reducing purchase written, because it's no more our purchases, because we are returning them back. Now, after that, all the entries that you could see are directly or indirectly connected with factory related expenses. These entries are indicative. There could be several more entries which are associated with factory related expenses. Example, factory rent, factory lighting, factory fuel, wages. This all are example of expenses which are incurred while producing any goods or services, and it is incurred in factory. So that is why these all expenses are written at the debit side of your trading account. Moving to the next at the credit side. We all know that generally factory is not meant for sales. They are not directly connected with as sales. However, those goods which are produced in factory are meant to be sold by the office or by the sales staff. So before we transfer this to the office people or to the sales staff, we have to write the cost amount of the product which has been gone for selling. So that is why at the credit side we write sales. It is an entry which always appears at the credit side of your trading account. The reason number one, trading account is a nominal account. And at the credit side, what exactly it indicates? It indicates your income, it indicates your gain. Whatever you have produced and whatever expenses that you have incurred is at the debit side. Now, those goods, when they are completed and when this raw materials have been converted into finished good, they had to be sold. So that is why we see sales at the credit side of our trading account. However, sometimes some product may be faulty. Our salesperson may return them back, or else our customer. So that is why we write less sales written, which would be deducted from the gross amount of sales, and the net amount will appear at the amount column. Many a time it happens that whatever raw material that we were using at the beginning of the year are unused. The certain part of the raw materials are unused. Okay, as our books of account has to be maintained year-wise, that is why at the last date of our accounting year, if we see anything which is unused, any stock which is not yet utilized, it would be considered as a closing stock. Now, closing stock cannot be an expense because they have been not used. It's true that it is not also your income. And that is why, while saying and while posting any entry in the trading account, you have to remember one basic thing. It follows nominal accounting rule. It doesn't mean that it is a nominal account. So at the credit side, you would see direct income, which is in the form of sales. And closing stock is not an income, but it is also not an expense, which is ideally should have been reduced from the opening stock or else from the purchases. But as per the accounting rule, we write it at the credit side because it is not the expenses. So indirectly it gets deducted from the purchases or the debit side basically. But to make your life easy, remember closing stock always appeared at the credit side of your trading account. Why? It is not my expenses. If it would have been my expenses, I would have written it at the debit side of my trading account. Okay. Now, you may either have gross profit or gross loss. Remember, your credit side of your trading account indicates your gain, your profit. If your credit side is more, then the balancing figure would be at the debit side, which would be considered as gross profit. And if your debit side is more, that is your expenses or losses, then the balancing amount would be at the credit side, which would be your gross loss. But make your life simple and see this concept is very simple if you understand the logic. Debit side is more. If debit side is more means my expenses and my losses are more, then of course it is my gross loss. If my income and gain is more, then of course it is my gross profit. That is how we prepare and close the trading account. Now it's time to move to the another account, which is profit and loss account, which seems to be lengthier, but it follows again the same basic rule that profit and loss account is also considered to be a nominal account. It is just like a nominal account. It means whatever you see at the debit side, it would be expenses. And whatever you see at the credit side, it would be income. Now, the next question which should appear in your mind, then what is the difference between trading account and profit and loss account if they are following the same logic? If I'm writing all the expenses at the debit side of my trading account, which I did earlier, then what I'm going to write at the debit side of my profit and loss account? Then remember there is a catch. I did say you that trading account records all the expenses related to factory. But a company doesn't run only through factory. There are offices, there are sales staff, there are admin work which are also done at place, and even expenses are incurred by these people. So we have profit and loss account in order to write the office and admin related expenses. We have profit and loss account in order to write marketing related expenses or finance related expenses. So if we try to understand, the very simple logic is any expenses which is related to office, marketing, sales, or finance, then it has to be written at the debit side of my profit and loss account. Okay, and any income which has incurred while doing work at office, while doing admin work, while marketing, while sales or finance, then it would be written at the credit side. So that is how it is different from trading account. Okay, now let us quickly go through what are the things that we could see at the profit and loss debit side. Generally, we can see all the office and admin related expenses. What are they? Salaries given to the office staffs. Okay, the way we give wages to our labor, which is written at the debit side of our trading account, it is a salary which is given to the office staff. So that is why which is it is at the debit side of your profit and loss account. Okay, the rent, rates, taxes that we pay, okay, through office, or the rent for the office. It is an office rent basically. So that is why it is at the profits and loss debit side. Then we have postage, stationery expenses, telephone charges, printing and stationery, office related electricity, insurance of the goods which are there at office, or equipments which are there at office. Okay, so this all are part of office and admin related expenses. Apart from that, you also do marketing and selling stuff. You do promotions, you do sales, so you need to pay salary to the salesperson. You need to maintain a godown which is not belongs to a factory, but it's the godown wherein you keep your product for a temporary purpose before you sell it to your customer. So you have a godown which is attached with your showroom. So those expenses are written at the profit and loss account debit side. Any discount that you have given to your customer while making the sales, any carriage outward, means you are providing free home delivery services, or else any services wherein your products are directly delivered to the customer, but it incurs expenses, isn't it? So they are a part of profit and loss account debit side. Now, it also includes finance related expenses. Now, what are finance related expenses? Let us try to understand here. See, we maintain current account in order to run the business. Of course, bank would charge in order to run this current account. So that is why, since it is maintained in office, this finance related expenses would be a part of profit and loss debit side. Similarly, if customers or shareholders have invested money, then we have to pay them interest, we have to pay them dividend, which is also a part of profit and loss account debit side. The repairs or the maintenance charges, the depreciation, the audit fees paid to the people who came to the office and did all the audit for our business, or any other sundry related expenses, miscellaneous expenses, is a part of expenses of profit and loss account. Now let us talk about the credit side. What exactly credit side would include? See, credit side indicates the income which I have generated from my business. Okay, and this income may be because office related income, selling related income, or finance related income. Even a company invests money in another company, then in that case, company is liable to receive dividend, company is liable to receive interest. If I also provide some other services wherein I charge commission, that is the company charges commission. When it receives commission, it becomes an income for the company. So those entries would be at the credit side of your profit and loss account. Any miscellaneous income would be considered as a part of income and would be shown at the credit side of your profit and loss account. Now you may definitely go through with the rest of the entries which are written at the debit side and the credit side by pausing the video. But now let us quickly go ahead and learn the statement. Okay. Before we learn the statement, let us understand the logic. We are talking about balance sheet. Balance sheet is a statement which divides all the entries into two parts, liabilities and assets. What is liability? A liabilities are those entries. In general, let us first try to understand this term liability. A company cannot exist on its own. It needs people to work. It needs owner who has an idea to start. Now, owner invests his hard money in the form of capital. So it becomes responsibility, liability of an organization to pay it off, to pay it back to the shareholders, to pay it back to the owner. All those entries are shown at the liability side. So the liability side of the balance sheets are the legal obligation of the company. It's true that company doesn't exist. He is not a human being. It is not a human being. However, it has legal existence. It means legally a company is liable to pay off all the money that has been taken from the owner or from any outsiders. Okay. So that is what written at the debit side. That is what written at the liability side of the balance sheet. Let's quickly go through what we can observe in the liability side of your balance sheet. In the liability side of your balance sheet, you can observe capital. Capital can be equity share capital. Capital can be preference share capital. This is what you can generally observe at the liability side. Why equity and preference? The reason is very simple, that the business was started with the help of their money, and it's a legal obligation of a company that that it has to pay off the amount which has been taken by the taken from the shareholders. Now, there is a slight difference between equity shareholders and preference shareholders, and you need to keep this in your mind so that in future when you come across with the same terminologies, then you may understand how far they are different. If they are considered to be a shareholders, what is the difference between an equity shareholders and a preference shareholders? Well, the name itself suggests, when I say preference shareholders, if in case this loss incur in the business, preference shareholders would be paid off first their amount and then the equity shareholders. There's a statement that we can use for these equity shareholders and preference shareholders. I grow, you grow is a statement that we can use for equity shareholders. It means when a company grows, the equity shareholders will also grow. However, in case of preference shareholders, I grow, you grow, and if I fall, you stand still. It means when a company grows, the equity shareholders will definitely grow. But when company falls, the equity shareholders will not fall. They will stand still. It means they would be paid off their money which has been promised to them. So that is why we say, I grow, I fall, you fall, justify equity shareholders. But I grow, you grow, and I fall, you stand still justifies for preference shareholders. Apart from this, any profit, any kind of reserves are considered to be a liability. Now, what are reserves? Basically, reserves are those profits which have been kept in various accounts, but it is a profit, and any profit which is kept by the company has to be paid back to whom? To the equity shareholders, because they are the earnings which are meant for the shareholders. However, if a company decides not to pay off this amount, the reason is there could be several ups and downs which may come in the business, and we may need money. So, from where we will borrow money? Asking loan to a bank or financial institution is not an wise option because they would charge you high amount. So, it's better to create a reserve and keep those amount in the reserves account. So that is why all the reserves, which are actually the earnings or the profits which are meant for the equity shareholders but not given to the equity shareholders, are considered to be a reserves, and it is a part of liability. Apart from this, all long-term loans, debentures, long-term borrowings are also a part of liability, because we means company has borrowed this fund in order to run their business time to time. Okay. So these are part of liabilities. What else you can see in your liability? You can see current liabilities. Now, current liabilities would include some provisions and some entries like bank overdraft, cash credit, outstanding expenses, sundry creditors, then bills payable. Now, all these entries that you could see at the current liability, what is the difference between current liability and long-term liability? See, current liability is a liability which can be paid off within a year. When I talk about long-term liability, it will take at least 3, 5, or 10 years to pay off. Okay. Now, all this liability, which is under capital or else reserve or long-term loan or else current liabilities, they are legal obligation for the company to pay off. Okay, that is why they are at the liability sides. Now, the last part of today's video is the asset side. What exactly the asset side would include? Asset side would include all sorts of fixed assets, which are utilized or used by the business for manufacturing purposes or to run the business smoothly, which would include tangible asset. Tangible asset example, land, building, furniture, fixtures, computer, machinery, which are used on day-to-day basis and which are used for a long run. We cannot easily sell them, though we can sell them, but we cannot easily sell them because of the huge value. So they are considered to be a tangible asset, which is a part of fixed asset. Apart from this, there are also four more assets, which is a part of fixed asset, and it is an intangible asset. Example, when I talk about intangible asset, it includes goodwill, patent, copyright, trademarks. Now, what exactly they are? The fame and name of the organization is what goodwill is. Patent, the process which are used by the organization in order to produce the goods. The copyright, the trademark, this all things are also useful in order to produce while manufacturing any products or services or for the working of the business, which is a part of fixed asset, but they are considered to be an intangible asset. Now, let's move to the next. Investment. Remember, here when we say investment, it means we are talking about long-term investment. Investment wherein we cannot withdraw the amount easily. Even a company has an option to invest in the equity of the another company, preference of the another company, or the debentures of the another company, or else in a fixed deposit. So they are a part of investment. Okay. Now, moving to the last thing is current asset. Current asset is also a part of fixed. Current asset is also a part of asset. When I talk about current asset, how far it is different from investment and fixed asset? Current asset are those assets which can be easily sold off within a year, but I cannot sell off my investment. I cannot sell off my fixed asset easily. Now you may have a question that you can sell off your investment day in and day out. And then those investment are known as marketable securities, tradable investment, which is a part of current asset. They are not a part of investment. Because while I was defining your investment, I did say it is a long-term investment. Now, let us see entries that we could see in current account. It includes closing stocks, any advances given, sundry debtors, then we have bill receivables, prepaid expenses, cash at bank or in hand, any kind of fictitious asset. So they all are part of your current assets. I would take in-depth session for fictitious asset in order to make you realize what exactly it is. Well, actually, it's not a part of your current asset. And how we need to represent them and why need to we represent them in the balance sheet. We'll talk about this when we learn the vertical statement. However, just for your understanding, remember, it's a company which have got a legal authority wherein they can also write fictitious asset, though it is not an asset. It is basically a loss. However, at this initial stage, not to confuse yourself, just see what are the entries that you could see at your balance sheet and the asset side, and just remember the basic logic that I have given to you. Thank you for now.